Hey, good morning, everyone. Marty Missouri here, 7/15/2022, Friday, with your weekly economic update and a brief stock market snapshot at the end. So our index this week essentially broke even. It did titch up just a tiny bit. We'll talk about the inputs in a second. Suffice to say that we are just bumping up the door of recession. May actually be there by the textbook definition once the Q2 GDP numbers come out, but ultimately it's the National Bureau of Economic Research that will give us the official word, and that'll come sometime later. As for a handful of our inputs, we'll start with retail sales. Those numbers came out, wrote about that this morning in the morning note. They were better than expected, and it was good news. In fact, there were several items of good news that I shared this morning. Stock market is certainly reacting positively to that, plus a good earnings report from Citigroup this morning is helping stocks as well. The retail sales number, I do want to put that into context because these are nominal reports, which means it's just based on the dollar value of the retail sales. So it's not necessarily that people are spending more on, say, number of units of goods. It's just that they're paying up for it. And when you factor in inflation, that pretty much explains all of it. But I don't want to completely negate it because it does say that people are still out there spending despite the fact that prices are going higher. So we had a 8.4%. That's the second month in a row of increase, and then a pretty whopping 1% month-over-month number. And then online retail sales actually went up as well. The weekly Redbook numbers, that was at 13% year over year, and you can see that's kind of consolidating right in here in terms of growth. So while it may not be all that it portends to be, or that some would portend it to be based on that number, it is definitely a good retail sales report. Surprising to many, including me, frankly. Next up, consumer sentiment. The University of Michigan number came out today, and as you can see, just a kind of a microscopic blip higher. What was encouraging, although it wasn't huge, was a slight downtick in inflation expectations. But suffice to say that consumer sentiment is clearly in the gutter. And yes, again, inflation does have much to do with it for sure. Weekly jobless claims are getting concerning. That still historically is not a high number, as I continue to tell you each week, but it's the direction and the rate of change. It's a pretty steep slope higher, and you can see what tends to happen, coming into recessions historically. So we had to downgrade our score of the jobless claims data. Small business optimism came out this week, continues to fall. Notably. So, small businesses are not optimistic about their go-forward outlook. The hiring plans, that had the nice spike, they spiked right back down. And that's still a very elevated level, historically speaking. And inside the report, it's not all bad from a hiring standpoint, other than the usual can't find people or the right people to fill the jobs we need. CapEx plans continue to roll over. That's the plans to expand their businesses. Again, so these kinds of numbers would be consistent with concerns over recession. Copper, wow, this is quite the correction, to put it mildly, right? We were calling for a correction up here, definitely up here. Definitely wasn't calling for this, I must say. We remain bullish on copper for many fundamental reasons, not the least of which has to do with just despite what we're seeing here, it's an industry that sorely lacks capacity based on what we expect to happen in the years to come, which we think leads to copper prices that will set new all-time highs, perhaps even in the not too distant future. There's lots of narrative out there about why this is happening. Of course, slowing economy makes some sense. Folks, I really think it's more about this than anything else. Biggest consumer of copper continues, as you can see here, this was yesterday's news, to lock down areas even as COVID cases stabilize, although this morning's news is that they saw quite the spike in COVID cases. As this headline said, they're doing a lot of mass testing. This is really a problem for them. While they're doing this, they're trying to offset it with economic stimulus. So it's actually showing up in some of their economic numbers, their industrial production numbers, and so on, particularly out of Shanghai, would suggest that while they're locking down, they're still taking people into the factories. And there does seem to be some demand for their exports. Exports were up 18% month over month. Imports, of course, were way down because they've locked down parts of the economy. As I've said umpteen times here, President Xi has to get reappointed. That'll happen sometime in the second half of the year. So suffice to say, there's a lot of effort that's going to be brought to bear on behalf of the Chinese economy in the weeks and months to come. Would not surprise me if that has a positive impact on the price of copper. Remains to be seen. Definitely will keep you updated herein. And then lastly, the producer price index came out this week. I think I hit hard enough the CPI on the written blog. So for today, we'll just take a look at the producer price index, which is big, up 11.3%. So we did have that 1 month reprieve. Back up month over month was a huge 1.1%. And when you look at the core, you can see, right now where a lot of that's coming from, where the core PPI is up 8.8. Remember, core X's out food and energy. So there's a lot of energy expenses in there, but heck, 8.8 is still huge. Bloomberg doesn't give us the monthly change for the core, but I happen to know that it did rise by 0.4%. So that would be a 5% annualized basis. And that's that month over month decline that we've been kind of flagging and looking for in many of the metrics. So folks, kind of in a nutshell, very, very close to recessionary conditions by our assessment. Not all bad, certainly areas that still look constructive. The article that I shared with you this morning on the written blog from the Wall Street Journal that actually showed some of JP Morgan's data, that even their lowest income customers are sitting on about 50% more in their checking accounts than they were before COVID. And this really speaks to the argument of the more optimistic economists out there. They seem to be becoming the minority, but nevertheless, they have continued to make the case that consumers are sitting on a tremendous amount of liquidity that should hold up the economy as we get into these more difficult stretches. I have kind of pushed back against that and said that that's very concentrated at the top. But as I said in the morning note, the 30% that's not toward the top, they say there's a lot of concentration, 70% of the savings are accrued to the more wealthy folks. Well, apparently that 30% is quite spread out. It's quite diffuse among everybody else. Enough to where, you can argue on behalf of these more optimistic economists, more optimistic perhaps than we've been, when it comes to that, savings data among the consumers. If we are in recession, we may very well be or about to be. But if suddenly the backdrop becomes one of a healthier consumer than we typically see during a recession, then you could begin to argue that it may not be all that deep, and that with regard to stocks, maybe our 3,500 level-ish, which we're pointing to, and I'll point to it here in a second, is a little more solid a line in the sand than I thought it was when I'm thinking, that recession is coming. Okay, look at the stock market. This time we'll start with the longer term charts and move all the way down to the 60-minute chart. So this is that monthly chart. Recall that on the momentum indicators, we have a real strong sell signal that outside of a recession takes us down to the 50-month moving average, which is, right around that 3,500 mark. So there's our target. Last time I drew a trend line that says if we continue at this pace, we'll be there sometime in the fall, which tends to be a tough time for markets. So it'll be interesting to see how the market meanders. Of course, we know that you're going to get these pretty strong bear market rallies. Definitely seeing that as I speak at you here today. Looking at a 3-year weekly chart, we still have this pattern that I showed you looking back 30 years. Looks pretty convincing that we should come down and test the 200-week moving average, which puts us just a little bit above 3,500 on the S&P. We've got this 50% retracement of this rally, which also can be pretty strong support as well. So we've got 2 levels of support if the market continues in this trend line. And yes, that takes us into the fall as well. Looking at the momentum indicators, there actually is a little sign of some support. Now, we're a long ways from a bullish divergence. or a buy signal on the MACD, but you can see by the histogram, which really sensitively measures this relationship here, that things are moving in the right direction. And then notice here we have a lower low on the index, and we do have what would be a positive divergence here on the RSI. So nothing to get overly excited about. Doesn't, to me, say that the bottom is in. We think logically there's still a leg lower. That's about 10% further down from here. Could be a lot worse than that if we enter into serious recessionary conditions amid a higher inflation backdrop. I couldn't think of a worse scenario, but that's not necessarily how it's going to play out. So much of it depends on what the Fed does, frankly. When your daily chart continues to look pretty constructive, remember we were a couple days ago, we were sitting right here, and while I was not feeling it, and we're still a long ways from something that we'd get super excited about, I did say we could very well, come through, break through here with some momentum. And if we were to crash through 4,000, we could see some option dealers having to hedge their upside risk and actually jump in and buy that. I mentioned that there's really big short interest in stocks, particularly the S&P. Don't have that data yet. We'll get that this afternoon in terms of the weekly update. But as of last week, big short interest. And so I also should add that today, when you look at the strength of the rebound, at least in the S&P, make no mistake, there's some serious short covering going on there today as well. So the people who were short saw the good news, market went against them. Covering those shorts will exacerbate the upside here as well. We still have these very definite bullish divergences on both the momentum indicators. None of this, folks, really at this point, I'd love for it to, but it doesn't yet convince us that this thing isn't going to go lower before it finally forms a durable or sustainable bottom. But again, we fully expect some pretty strong rallies along the way. So it'll be interesting to see how we go into next week. Also a big options expiration date today as well. So all these things can impact moves and exacerbate them in one direction or the other. And then last but not least, the 60-minute chart. Remember we drew our symmetrical triangle here. We were breaking down below it, and I said the market's trying to fight its way back in. Well, it's right there now, just really bumping up hard against this 3860 level. You can go back and see how important a level that's been. All the way back to May. Strong support, tested it, succeeded, failed it for a minute, then tested it here. Gap down below it, and then it became resistance for a while, right? Even 3,800 as well. And then, so kind of dancing all over that line makes some sense that if the market's going to struggle, it would struggle first there. Then it's going to have to butt up against this trend line here, and that 4,000 I think is going to be tough to overcome. But if it does, we could get something special even beyond that to the upside. Nothing really changing here. This is just confirming the move. That's a buy signal. Yes, we do here on the RSI though have a positive divergence. That would be bullish. You've got the lower low and you've got a higher low here on the RSI. This one is just confirming what we're seeing in here. So folks, I'll leave it there. As always, we sure appreciate you watching and listening, and hope you have a wonderful weekend. Talk to you again soon. Bye-bye.